ARM loans are starting to get a little bit more attention in the industry, in the mortgage industry, and in general in the financial industry. I mean, frankly, I haven't originated an ARM loan in about 5 years. ARM loans have not been a major part of the mortgage industry for quite some time. The rates on them simply haven't been that good when you compare it to 30-year fixed, even with the increase in the fixed rates that we've seen in the last year or two, or a couple of years. But there's been a recent shift in market conditions that are creating an opportunity. Now, that opportunity, oddly enough, is specifically associated with the FHA 5/1 ARM. So that's what I want to tell you about a little bit. FHA ARMs right now can offer rates 0.5 to 1% below a 30-year fixed. Conventional ARM loans, not so much. The spread between a conventional ARM start rate and a conventional 30-year fix is still pretty narrow. But FHA, it's getting pretty wide just based on what's going on in the financial markets. And the thing about the 5/1 ARM, let me explain what that means and how it works. An FHA 5/1 ARM, what that means is you're going to get an initial interest rate that's going to be fixed for 5 years. At the end of 5 years, the one in that description, 5/1, the loan will then adjust annually every year, once a year. So a 5/1 ARM fixed for 5 years, then it adjusts annually every year, once a year for the additional 25 years to get to the full 30-year term. Now, a conventional ARM, just as a point of comparison, they work a little bit differently. Conventional ARMs, the most common ones that are offered today are fixed for 5, 7, or 10 years. So that's good. I mean, those are part of the reason we call them hybrid or fixed ARMs, because you have a good fixed period that can be as much as 10 years. But with a conventional ARM, the standard core product that's available today, they adjust after the fixed period on a semi-annual basis every 6 months, not every year. I would call that a less desirable adjustment schedule than the 5/1 ARM that the FHA offers. More frequent adjustment intervals means a potential of more frequently seeing the rate go up in a rising interest rate market. But of course, at the same time, if we have a lower interest rate market trending, then you maybe get to take advantage of that more often. Now, the key thing to look at when you're looking at these ARMs, and this is where I think the FHA ARM has a great advantage over conventional ARMs, are the caps. Okay. Now, the caps with the 5/1 FHA ARM, they are what we call 115. Okay. 1% the first adjustment. So you have the loan for 5 years, and then in the start of year 6, you can have an adjustment in your interest rate, but based on the index, which FHA loans are tied to the 1-year constant maturity treasury index, plus a margin added to it. That sets the rate for the 6th year. But if it causes an increase in your fixed 5-year fixed rate period, you're capped on that increase at only 1%. So you cannot go higher than 1% above your start rate, even if the index plus margin is higher than that. And then each subsequent adjustment is also 1 year, again, for the entire remaining 25 years life of the loan. And then it has a 5% life cap, meaning if you start at, say, 5.5 on a 5/1 ARM, your life cap means you're not going to ever be higher than 10.5. Now, a conventional ARM, the caps are different and not as good. A conventional ARM, the standard caps are 515. And here's the scary part. Let's say you get a conventional ARM with a 7-year fixed period. Well, that's good. You get an extra couple of years. But then when it adjusts in year 8, if the index plus margin, now with the conventional ARM, the index is the secured overnight financing rate, what we call SOFR. That's actually, and then a margin is added to that. If you're fixed for 7 years and then the index has to be, or the rate has to be adjusted in year 8 based on the SOFR plus the margin,